Welcome back to another video, ladies and gentlemen. Today we're talking about a surefire way to increase your monthly cash flow by $1,000. Over the course of the next 15 years, this will help you hold on to $70,000 and maybe even upwards of $100,000. This is baby step number 6 in the Total Money Makeover and focuses on completely paying off your mortgage. Before you start doing so, you should have all other debts completely paid off. This includes, but it's not limited to, credit card debt, student loan debt, and maybe any medical bills that you've incurred in the past. If you still have to attack some of those smaller debts, you can check out my video on the Debt Snowball. I'll throw that up on the screen as well as a link in the description. Don't forget to like the video and subscribe to the channel. I'm currently working on a video which will probably come out next week, outlining the 7 baby steps in a single, more comprehensive video. That way you don't have to jump around from video to video and try to retain all the information when we talk about it in depth. What we're going to be focusing on today are some classic myths around mortgage loans and mortgage payments. We're also going to look at how beneficial it will be to you to pay off your mortgage quickly and efficiently rather than continuing to refinance and draw out that fee.
Skies are clearing up.
The first thing I want to look at is this mortgage calculation over the pay period of 30 years. The reason I want to look at the 30-year mortgage period first is because this is the time frame in which most people will be paying off their mortgage. This is just a simple mortgage calculator from Google, and it has an interest rate of 3.92%. If you applied for your mortgage with a fixed rate, your interest rate may be a little higher. I urge you to take my examples as a ground base to develop an understanding, and then outline your more personal experience with the numbers unique to you. So the mortgage amount we're talking about today is $190,000. I'm using this number because the average value of a home in the United States is currently around $210,000 to $220,000. If you purchase a home that costs $210,000 with a $20,000 down payment, then your mortgage is $190,000. You can see right here that the monthly payments are just below $900, and the total cost of the mortgage spread out over 30 years is $323,405. Comparing that to a mortgage period of 15 years with the same mortgage amount, $190,000, and interest rate at 3.92%, we can see that the monthly payments increase to $1,400. Although you will be paying an extra $500 a month, the total cost of the mortgage here is $251,604 rather than the before mentioned total cost, which exceeded $300,000. I want to compare these two in an Excel spreadsheet. You can see that the mortgage amount and interest rate are exactly the same. The only variable is the pay period. By paying off your mortgage 15 years quicker, you save a total of $71,801. I know it may be difficult to come up with an extra $500 a month, but in the long run that will be very beneficial to you, especially if your mortgage loan has higher interest rates or the value of your property was more expensive. It is not at all uncommon for people to refinance and borrow against their mortgage, in which case it will just take them longer to pay off that principal, allowing the lender to earn more profit as the loan continuously incurs greater amounts of interest. Additionally, with that almost $72,000 and an extra 15 years of time, you will have a multitude of opportunity to invest that money and allow it to grow exponentially over the remainder of your life. Maybe you have a business that you've been wanting to start for some time, but you just haven't been able to find the money, or even this could be a massive boost to your retirement portfolio. If you feel like you're a little late to the party and saving for retirement, you can check out my video on 5 ETFs for retirement, which reviews 5 different exchange-traded funds, which will give you the best chance of your retirement portfolio increasing in value as a result of proper diversity. The next example we have to talk about is a very common myth around mortgages, and that is in regard to your mortgage payments and the tax deduction that they allow. Many people believe it's not too important to pay off your mortgage quickly, as you are allowed to write those payments off in your taxes against any capital gains which you have made. I'll show you in a simple fashion with numerical examples why this just isn't true or the smart decision to make. For this scenario, we're looking at cost of mortgage, same as discussed before, $190,000 along with that 3.92% interest rate. And again, we'll be focusing on here that 30-year pay period. From the mortgage calculation, which I showed earlier, the monthly payment of a $190,000 mortgage over 30 years is $900. That means over the course of a year with one payment per month, your annual mortgage cost is $10,800. Although the ability to write off that $10,800 may seem like it will benefit you, it is really a much better decision to pay that off as quickly as possible. If instead you could not write off that extra $10,800 and you were paying a tax rate of 30% on it, you would only be paying $3,240 in taxes on that money. The reason that this so simply shows that it's a bad idea to keep your mortgage around just so you can get that tax benefit is because you're still paying that $10,800 to the lender each year. Although many people believe it's beneficial to keep this $10,800 around for the tax write-off, it would really behoove you to not need to worry about or pay this to the lender each year, and instead just pay the $3,240 in additional taxes. Just looking at these numbers alone, you can see that you're saving a little more than $7,000 a year if you did not have to make those mortgage payments and instead just paid taxes on that additional income. I hope this video helped clear up some misconceptions that you had about mortgage loans and their payments alike. The faster you can get your mortgage paid off and the faster you're no longer indebted to anyone means you will have more time for your money to begin to drastically grow. It's important that you don't start attacking that mortgage before you get rid of your smaller debts. Although we dispelled the myth of the mortgage tax write-off, it is still somewhat beneficial because it's not like you can take your credit card payments and student loans as a tax deductible. Don't forget to like the video if you found this information helpful. Subscribe to the channel and hit the notification bell to help you achieve your goals in regard to financial freedom. As I said earlier, the 7-step total money makeover video is on its way. And once we've discussed that, I really want to start diving into additional investments, and then I'd like to begin doing some stock reviews. As always, I'm Patrick Zimmerman. Thank you for your time, and enjoy the rest of your day.